Picture this, a warm family handshake. You just bought your parents' flat for 65 lakh to, help them out, even though the market value is sitting at 1.3 crore. And while you're at it, you give your brother a 40 lakh interest-free loan so he can kickstart his new business. Honestly, it feels like perfectly normal family stuff, right? Well, imagine that warm, fuzzy feeling completely vanishing the second an income tax department notice pops up on your screen. Because guess what? Transfer pricing just applied to both of those family favors. Today, we're unpacking exactly what that means in this explainer and, more importantly, how you can protect yourself. Now, you're probably thinking transfer pricing is strictly a corporate headache, right? Like those massive rules designed to stop giant multinational companies from quietly shifting their profits overseas. But here's the thing. While that corporate rule absolutely exists, the individual reality under the Indian Income Tax Act is very, very different. Sections 92A and 92B literally pull everyday individuals right into this incredibly complex compliance net. If you're doing cross-border financial transactions with your family, trust me, the taxman is watching you with the exact same magnifying glass they use for global corporations. I'm going to break down these crazy complex legal definitions for you in exactly 10 seconds. Ready? A family relative plus an NRI equals an instant transfer pricing trigger. That's literally it. The very second a non-resident Indian does a deal with a resident relative, the law instantly slaps a label on them. You are now an associated enterprise conducting an international transaction. Just like that, you're caught in the transfer pricing net. And here's the trap we see families fall into time and time again. Section 56(2)(x). This is the domestic gift tax exemption. See, this rule allows tax-free asset transfers between close relatives, which sounds great, but it creates this massive, dangerous, false sense of security. Families just assume, hey, domestic gift tax exemptions protect us, so our cross-border family deals are totally immune to tax scrutiny. But spoiler alert, transfer pricing rules absolutely bulldoze right over this comfort zone. Okay, let's look at our first case study. Focus on this number right here, 65 lakh. This is the property trap. In our scenario, an NRI buys a flat from their resident parents for 65 lakh rupees. Between you and me, it sounds like an awesome family discount, especially since the actual market value is a whopping 1.3 crore. But the income tax department's automated systems, they don't see a sweet family discount. They just see a giant red flag. And here's the shocking punchline. The tax officer is going to step in and apply what's called the arm's length price. Basically, they look at what a totally independent buyer would have paid. They rewrite the entire sale in their system, and boom, that 65 lakh gap is taxed. Your parents get slapped with a massive retroactive capital gains tax on a phantom 65 lakh difference, money they never actually saw a dime of. Oh, but wait, it gets so much worse. This devastating adjustment doesn't just stop at your standard capital gains tax. That primary tax liability, it automatically triggers a compounding 200% penalty under Section 270A for misreporting the transaction value. So your parents' nice attempt to give you a family discount literally just mutated into a total financial nightmare. All right, so that's the real estate side of things. But what about the second part of our scenario? What about that seemingly totally innocent 40 lakh interest-free loan you gave your resident brother? I mean, surely helping your own sibling start a business without charging him interest has got to be safe, right? Welcome to the most brutal regulatory catch-22 in all of Indian tax law. On one hand, FEMA, the Foreign Exchange Management Act, explicitly demands that if an NRI gives a foreign currency loan to a resident relative, it absolutely must be interest-free. But on the other hand, transfer pricing rules strictly prohibit zero-interest cross-border lending. They demand a commercial arm's-length interest rate. You literally cannot obey one of these laws without breaking the other. It's wild. And because you technically broke the transfer pricing rule just to comply with FEMA, here is the second massive shocker. The tax department is going to benchmark that nice family loan against commercial lending rates. Think something like the State Bank of India's prime rate. So arm's length interest is calculated on that 40 lakh. The NRI lender is then fully taxed on notional interest income. Yep, phantom interest you never charged and never actually received. The sheer unfairness of this whole mechanism is perfectly captured right here. Section 92(3) explicitly prohibits any transfer pricing adjustment that reduces taxable income. Meaning, the NRI is forced to pay tax on this phantom interest income, but the resident brother who actually borrowed the money, he's legally barred from claiming any corresponding tax deduction for that expense. It is a completely one-way street where the taxman always wins. Now, if you're sitting there thinking, well, I've done this kind of stuff before and I've never been caught, I need you to listen closely. The game has fundamentally changed. Let's talk about the 2026 Income Tax Act update. The days of flying under the radar with casual, informal family transactions, those days are officially over. Historically, you'd report this stuff using the old narrative-style Form 3CEB. It was mostly text, pretty easy to gloss over. But today, that old form is gone. It's been entirely replaced by Form 48, which is a data-rich, completely machine-readable reporting format. It doesn't want your paragraphs. It wants standardized data points that are fed straight into automated analytics engines to instantly flag anomalies. And the new compliance burden really boils down to this. CA certification is mandatory above the threshold. But here's the catch you absolutely need to remember. While domestic family transactions have a super high 20-core threshold before these rules kick in, the second an NRI is involved in an international transaction, that statutory threshold drops straight to zero. Every single repeat requires an accountant's stamp. Thanks to this new data-driven risk selection system, if you fail to file Form 48, or if the machine reads your data and sees you bought a house for half the market rate, or handed out a 0% loan, this system won't even hesitate. It triggers a transfer pricing audit instantly. The human element of tax scrutiny is basically gone, replaced by relentless automated algorithms. Okay, so moving into the defensive playbook, let's talk about how to actually shield yourself. It comes down to two absolute non-negotiables. Step 1, get a registered value or report. Before you transfer any property or shares, you have to hire a government-registered valuer to establish the true arm's-length price. Step 2, execute a formal loan agreement. You've got to drop the informal handshakes. If you lend money, draft a rigid commercial contract that explicitly states the terms and the interest rates. And to actually defend those agreements, you need to compare the asset with a solid benchmark. For real estate, you're benchmarking against local stamp duty circle rates or recent registry deeds in the area. For family loans, tie your interest rate directly to the SBI prime lending rate or the SOFR rate if it's foreign currency. Having this documented, side-by-side comparison is what builds an impenetrable defense when the tax scrutiny comes knocking. Look, if you're sweating a bit right now, realizing you might have done a family property deal or handed out an interest-free loan recently without any of these protections, take a breath, don't panic, but you do need to act. DM me the letters TP on my socials, and my team will set you up with a completely free transfer pricing exposure check to see exactly where you stand. I want to leave you with this one final thought to chew on. If your family's simple financial favors are suddenly being treated with the exact same suspicion and analytical rigor as massive multinational corporate tax schemes, is any handshake truly safe from the tax man anymore? We are living in a whole new world of compliance. Thank you so much for joining me for this explainer. Stay structured, stay compliant, and I will catch you in the next one.